So now let's get started on part 2 with thinking about how taxes affect the equilibrium price and quantity. First, let's think about a tax on sellers. And for this whole chapter, we're going to assume a fixed excise tax. So the idea here is the tax is a simple flat dollar amount per unit of quantity. Now, obviously, in the real world, many taxes are what we call ad valorem, or they're a percentage of the value of the transaction. These actually tend to be a fair amount more complicated to model, so usually we leave them for a later course in economics. So for now, notice that if we tax sellers a certain amount for every unit that we sell, we're going to add to their seller costs. So we're adding to their effective seller cost. Also remember that the height of the supply curve at each level of Q is the seller cost for that unit of quantity. So what happens is we place a tax on the product and it causes the seller cost to increase and the supply curve to shift up. So in this case, if we have a 50-cent tax, if sellers used to have a seller cost of $2.80 to sell this 90th unit, they now have a seller cost of $2.80 plus 50 cents, or $3.30 to sell that unit. So this happens all back and forth all the way along the supply curve, and we're going to go ahead and have the supply curve shift up and the equilibrium price rises. Notice that the equilibrium price doesn't rise by the full 50 cents. The old equilibrium price was $3, and the new equilibrium price is $3.30. And this comes about because the sellers are able to pass along some of the tax to consumers, but not all of it. So in this case in particular, the sellers were able to pass along 30 cents of the 50-cent tax, but the sellers themselves, if they get paid $3.30 from the buyers, they only get to keep $3.30 minus 50 cents, or $2.80. So the sellers pay 30 cents more, and the buyers pay 30 cents more, and the sellers get paid on net 20 cents less. Notice that, from a certain point of view, taxes are a kind of punishment. If you do something, we're going to take money from you. So when we have taxes, we're going to discourage an activity. So sellers supply less, and notice that buyers and sellers shared the burden of the tax. The 50-cent tax was 30 cents from the buyers and 20 cents from the sellers. So even though sellers were not directly taxed, they are harmed by the tax. And even though sellers were able to pass along some of the tax, they weren't able to pass along all of the tax, so they are also hurt by the tax. What about a tax on buyers? A tax on buyers lowers their effective willingness to pay. And as I say in my little example here, well, if you were ordinarily willing to pay $8 for something, but you know you're going to have to pay a $2 tax, then you're only willing to pay the seller $6. We combine that knowledge that a tax lowers effective willingness to pay, with the knowledge that the height of the demand curve at each point is the buyer's willingness to pay for that unit of quantity, and we see that a tax causes the demand curve to shift down, and it shifts down by the amount of the tax. So, if the 90th unit used to have a willingness to pay of $3.30, that shifts down by 50 cents to $2.80. If we look at what the effect on the market equilibrium is, if we had an old market equilibrium of $3 and the demand curve shifts left or down, we're going to have a new market equilibrium, say in this case of $2.80. And notice the 50-cent tax caused the market equilibrium price to decline by 20 cents. So even though sellers weren't taxed, they are able to get 20 cents less for their product, so they suffer 20 cents of incidence or harm or burden. Buyers pay $2.80 to sellers and 50 cents in tax, so they pay $3.30 in total. So they are 30 cents worse off than they were in the original market equilibrium of $3. So again, taxes are a kind of disincentive for buying, so not surprisingly, people buy less. The buyers and sellers share the burden of the tax, and so we end up having, again, the burden of the tax shared here between the two parties. And both parties are harmed by the tax, regardless of which of the two parties the tax is actually imposed on.